Tomorrow. Tomorrow has a way of sometimes surprising by presenting things that you certainly weren't expecting today. Africa's tomorrow. Our future is predictable. Billions are being invested in infrastructure. Our middle class is growing. Agricultural sectors are thriving. The world is looking to us to replenish their energy and mineral resources. Our entrepreneurs are making their mark on the world. Today in Africa, a prosperous future can be assured if the risks of tomorrow are secured. Meeting the uncertainties of tomorrow is our everyday business. For 70 years, we have helped manage risks and secure the growth of the continent. We've been there as risk advisors for farmers, for governments and investors building infrastructure vital for growth, for power grids that power economies, for mines that are the treasure trove of our resources, settling claims for properties destroyed by fire, for employers and employees who want to secure their health and retirement benefits, protecting businesses against the threat of cybercrime, data loss, and other risks. We've been there as risk advisors for all of life's unpredictable moments. Our business stands on 3 pillars: risk, reinsurance, and people. For 70 years, we've been an agile, trusted advisor to clients who want custom and homegrown solutions rather than conventional offerings. Our values are at the heart of our business and our relationships: honesty, expertise, agility, respect, teamwork. We are Aon's trusted global network correspondent in Africa. We are Minet. For every one of the thousands of businesses and people we serve, and for many of life's unpredictable moments, our purpose is clear. We partner with you to secure tomorrow.
Now we're going to go through a different topic, and we want to discuss about the possible impact of COVID-19 on product design and pricing. We know that COVID has definitely changed the game. It's changed the way we do our business, the way we think, our strategies, and what we need to do to be able to go forward. And to take us through this particular session, this is the Chief Actuary at RL 360. This is none other than Donald McLeod. Welcome, Donald, and take us to the next level. Engage us and tell us the impacts of this particular pandemic and how we can be able to change things and be able to adapt, transform, and move forward. Welcome, ladies and gentlemen, and over to you, Donald.
Good morning and welcome from sunny Glasgow in Scotland. My name's Donald McLeod and I'm the Chief Actuary at RL360, a life insurance company based on the Isle of Man. Thank you very much for inviting me along this afternoon or this morning to give a presentation on the impact of COVID-19 on the design and pricing of life insurance products. The agenda that we're going to walk through today, we're going to look at the possible impact of COVID-19 on the markets for life insurance products, and then the possible impact on product design. We'll then look at the potential impact on pricing and the possible impact on assumption setting. And I'm hoping that there'll be time for questions. If we don't have any time for questions today, then please feel free to get in touch with me at any point. The markets have been massively impacted by COVID-19. Earlier this year, we saw worldwide equity markets falling by up to a third in some places. There's been a recovery since March, April, May, round about then, and markets are currently still down, but not as much as they were at the start of the year. When I'm speaking just now, it's probably around about 15% in the UK equity markets. One of the other impacts that we've seen is an increase in unemployment. Now, that's a trend that is likely to only increase, unfortunately, with the impact that COVID-19 is having on many businesses. One of the consequences of that is that individuals will have less disposable income. A corollary of that is that we may see some policies, in particular regular premium policies, lapsing, or people paying up their policies, so keeping the policy as it is, but not paying any future premiums. So what does this mean for product design? Well, one of the consequences of there being less money available in the markets through unemployment and other factors like that is that there is likely to be less people available to buy savings products in particular. As the impact of COVID sinks in globally, we are likely to see insurers trying to be more flexible in what they can do. And I know that we've seen that as a company ourselves. So one of the things that we will seek to do is to try and give policyholders greater flexibility around things like the premiums that they pay. So for example, allowing them to have longer contribution holidays where they don't pay premiums. Alternatively, we may look to revise product terms by lowering the minimum premium that is expected to be paid for policies. And that should allow policyholders to try and keep saving, whether it's in the long term or the short term, reflecting the fact that financial circumstances are more challenging right now and potentially going forward as well. We may also see an increase in the demand for protection products, whether that again is life insurance products or whether it's critical illness products. And what we may see is companies developing specific protection products for COVID-19. That may be challenging just now because there is so little available information on COVID-19, and more information is becoming available fairly rapidly. So the situation is fairly dynamic just now, and it'd be fairly bold to be able to come up with a series of credible mortality rates for COVID globally or at a local level. So I think we're arguably a fair way away from being able to have COVID-19 specific products. However, firms may offer COVID-19 as or may seek to introduce COVID-19 as an exclusion for existing products. So, a year ago, nobody was talking about COVID-19. Now we're all obviously talking about it, and firms may want to reflect the risks of COVID by changing the policy terms and conditions. That's often not particularly easy for existing business, but for new business, they may seek to introduce that as an exclusion. And what I would anticipate is that firms around the world, in particular the large reinsurers, will be working together to try and find a solution that meets their needs, but also meets the needs of the market. And again, that's not straightforward. In particular, the amount of information that is available is changing, and so the expectations of the market may also be changing. As insurance companies, we always have to take into account TCF, so treating customers fairly. That can apply both to in-force business, but also going forward for new policyholders. So we have to, in my opinion at least, we have to be mindful of the fairly horrendous circumstances that many people have gone through and are going through with COVID-19, and try and be as fair as we can to policyholders, both in terms of the product pricing, but also the way in which we manage our claims process, for example. It's been a really difficult time for so many people, and I think as an industry, we are obliged to try and be as helpful as we can be. There's also public relations considerations. In some cases, you may find claims which, according to the terms and conditions, may be rejected. But given the current circumstances, I think there may be firms who are probably a bit more liberal with the claims handling and may pay out cases that they may not have paid out in other circumstances. Again, trying to reflect the bigger picture of what we are experiencing globally. When it comes to pricing, there are some kind of general rules that we have. We need to set assumptions for a whole series of different factors. And for each of those, what we are generally trying to do is to try and predict what we think will happen in the future. So the pricing should reflect our expectations around future experience. How has COVID-19 impacted those expectations? Well, we need to take those into account. Some of the economic factors have changed. As we mentioned earlier on, the markets have fallen by up to a third. So that the impact of that is on the future investment returns which may be experienced. For some products, in particular investment savings products, the return which firms make and the charging structure that they can charge is hugely dependent on the investment returns which firms can expect to make. So how do we reflect the recent drop in the markets and the pricing? Do we expect that to continue or not? What about expenses? Again, we've seen expenses impacted by COVID-19, not only in a negative sense, but just the fact that some expenses are changing. The behaviour of firms has changed. My firm went through a period where we all worked from home. All of our sales agents are working from home at the moment. And so you may find that some of the traditional expenses for insurance companies around buildings may fall. For firms like ours which sell globally, or even firms which sell locally, some of the expenses around travel may also be impacted. So you may find that in some cases you'll see a drop in your expenses. Other cases you may find the costs increasing, but the key point is that we need to reflect those changing expenses going forward, and even if the aggregate expenses haven't changed, if we anticipate lower new business volumes, then our per policy costs may go up. So we need to build that factor into account as well. As we said there, the new business volumes are likely to drop given the lack or the drop in disposable income. So take that into account as well when we're setting our expense basis per policy. What about the non-economic assumptions? Again, we need to reflect those in the pricing basis. We also need to think about different pricing criteria. Now, what that means is that as we've gone from a pre-COVID world to a post-COVID world, the economy has probably fundamentally changed. There's been a step change, and that may impact the level of profitability that firms may be willing to accept going forward. So cases that may have been rejected pre-COVID may be accepted post-COVID if the pricing requirements are revisited by firms. Firms may have to accept a lower profitability margin going forward. And also regulatory considerations. So firms may want to make changes to product terms and conditions or to the pricing basis going forward, but we always have to reflect any regulatory considerations within those discussions. That may involve minimum pricing, minimum premium payments, specific exclusions that aren't allowed and so on. And within regulatory considerations, we also take into account TCF as well. So, as I mentioned, the assumptions should reflect the future expectations. Often, the way that we go about that is by looking at historic experience, making adjustments to allow for any expected differences going forward. And what we need to think about is, are the changes that we have seen recently temporary or permanent? So if we look at the mortality, for example, well, we look at investment returns, we've seen that the market's going down by I say about a third or thereabouts. So how do we set the assumptions going forward for investment returns? How credible is the information for the last 6 months or thereabouts around the markets? The volatility that we've seen, do we think that's going to continue going forward? It's a hugely challenging exercise. I would expect firms to work with local regulators to try and understand their expectations as well around that, and auditors and so on. Expenses, as I mentioned, we need to look at, often we look at the previous year's expenses as the basis going forward. How credible is that going forward? Or have we seen a step change in the expenses, particularly for large firms where we're looking at kind of international travel, which may not be happening anymore? Expense inflation is tied into the two previous points. Often the expense inflation will be linked to gilt yields and real nominal. So what is happening with those? Mortality is an interesting one. Again, the mortality is often based off standardized tables. So we need to think about how likely it is that those standardized tables are going to be realistic going forward. Does there need to be a review of standardized tables to reflect COVID-19? The mortality rates from COVID-19 on their own don't seem to be having a massive impact on the overall mortality figures, but as the situation develops, that needs to be noted, monitored, and reflected in the assumptions. Exact same situation with morbidity that we need to think about those. Lapses, we've probably seen, or we are probably seeing, a spike in lapse activity to reflect the fact that people are being hit financially during the kind of lockdown just now. So we need to think, how do we reflect that in our assumptions? Do we just exclude the last 6 months worth of lapses? Or do we anticipate that continuing going forward? That's a really difficult discussion, and probably involves us trying to assess why people are lapsing just now, and do we expect that scenario to continue going forward? And PUPs, similar again, people paying up their policies, leaving the policies they are, probably increased over the last few months. So how do we reflect that going forward? Again, probably the best, or one of the best ways to analyse that is to try and gather as much information from policyholders about why they are paying up their policies. Some other considerations when setting assumptions. The valuation assumptions are usually set by the board, so we need to be really careful that the board are getting all of the information that they need to set this. It's probably going to be even more confusing to explain why the actuaries are proposing the basis that they are for valuation. So really clear, concise information is needed, and in particular making reference to how COVID has or has not reflected the assumptions that we are expecting to propose to the board. There's probably going to be more expert judgment this time round setting assumptions, and again, we need to be really clear in where we are applying expert judgment to make it clear to the board and others how we are trying to reflect these challenging circumstances. We do need to justify the assumptions that we are proposing. So I suspect that we will have more paperwork, more documentation, arguably more sensitivity testing to try and justify what we are proposing. Auditors also have a challenge. They need to audit our assumptions. So how do we provide all of the information that they need for that? Again, it's probably going to be a more involved process this time round than it was last time round. And similarly, regulators will also face increased challenges around making sure that the assumptions are being set appropriately. So we need to think about how can we help the regulators? What information can we provide to them to make it easier for them to see that we are reflecting the challenges of COVID appropriately in our assumption setting? Those are all the points I was going to cover, but I'm more than happy to take any questions that anyone has. Once again, thank you very much for inviting me along to present. I hope it's been useful and look forward to seeing you all soon. Thank you.
Insurance is one of the trusted financial methods of managing everyday risks. It operates on the basis that losses and misfortunes can occur anytime. Insurance Regulatory Authority was established to regulate, supervise, and promote the development of the insurance industry in Kenya. One of our core functions is to protect the interest of policyholders and beneficiaries like you in any insurance contract. We advise consumers to provide honest and accurate information while purchasing insurance. Providing inaccurate information breaches insurance contract and may lead to a claim being denied. In the event of a loss, all you need to do is to lodge your claim, provide the necessary documentation with your insurance company to get compensated. If you have any complaint regarding your insurance policy, visit IRA offices for assistance.